Okay, good evening, everybody. Thanks for viewing our website and looking our video. I'm trying to use this short video to explain a bit about what we're going to discuss during our joint venture training. We see that this topic is very important and hopefully is interesting for the business community. Because in this nowadays we know that not a single company that can really have all the resources, all the personnel, all the capabilities, all the funding that can really make the business grow to the second step or to the third level or to the fourth level. So ultimately they don't have any choice. They have to look for the partners to work together, where they put together into the one vehicle, whether it's a legally spirit or not a legally spirit, from the joint investor, and then they combine all the resources and trying to put effort to make it's possible for both of them to achieve to the objective of the business. And in this training, we try to discuss three important topics. First is the structure of the joint venture, and the second topic is accounting. Why we involve the accounting in this joint venture discussion? Because in the business we know that people always talk that we need a good lawyer at one side, but the other side we need a good accountant. So we don't have any choice because whatever that you put into your books, that will people will read your business through your financial statement. So we really have to look and understand how the joint venture will be reflected in the financial statement. And the third is, last but not least, is the tax implication. We know that the tax has their own regulation, and then they have their own view about the joint venture. We need to understand what's the difference between what the accountant view the joint venture and then what the tax authority look into the joint venture. So we hope that this 2 days training will really help the people to get at least the big picture about joint venture. Okay, joint venture is a very generic word. Everybody talk about the GV, about the joint venture, and then talk about the KSO. KSO is a kerjasama operation, but in May 2011, the IFRS 11 is announced and published. Basically, they move from the joint venture to the what they call is joint arrangement. Okay, I put here the joint arrangement. So you have a joint venture, but they change from the joint venture to become joint arrangement. Okay, so joint arrangement is identical with what we call joint control. There's two key words we have to remember. First is arrangement, and second is the joint. So basically, we need more than one party, or at least there's two parties or investor. And then this will support by what we call contractual agreement or arrangement. So through this contractual agreement, these two parties agreed to share the control. So this is followed by share the control over the investee. Okay, so the control here, we need to understand why IFRS 11 make changes to to the previous accounting standard. First, in the previous standard, what we call is IAS 28, there's so much focus on the legal structure of the joint venture. Okay. But in the IFRS 11, this is no more. They focus more on the rights and obligation. Personally, I agree with this approach because in the proportionate consolidation application, the investor recognize the asset and liabilities based on the proportionate ownership share that they have. But the big question is, whatever the asset that you recognize from the joint venture, whether is this really your asset, is whether you have a rights to the asset or you really have the obligation for the liabilities of the investee. So based on this IFRS 11, they've put back to the focus on the rights and obligation. So in the investee, you know that there's a right, there's an asset and liabilities. Okay, and then if these two components, you put the minus here, you get net assets, or you can have the net liabilities. So the question is, if the investor have the rights to the net asset, then basically this is called joint venture. In this case, the investee is regarded as a separate ring-fence entity that they own their own asset. They make the agreement with the third party on their own behalf, on their own name, and then the joint venturer just look at the right to the net asset. But if the joint venturer have the right to the asset and obligation to the liabilities, is called joint operations. And normally, this is have no legal structure. Separate structure from the joint venture. But in joint venture, you have the separate entity. Okay? Or structure. Financial separate structure. Okay? Yes, I think this is a very short overview, but during the training we're going to, this is a 2 days training, so we will discuss a lot of topics that we're going to talk about what it's mean with the control, because we need to understand what it's mean with the control, because the control is the underlying of the joint control, and also what you're going to put in your consolidated financial statement. So we're going to talk about the control, we're going to talk about what it means with the power, abilities to affect the relevant activities of the investee that will affect or will have an impact to the returns that you're going to, as a joint venturer, you're going to have exposed or rights to that. So basically, in the joint arrangement, there will be two parties. There will be investor, and then you have your investee. Okay, and then there will be a return here. Your return could be positive, or positive could be negative. So, if you have the ability or power to affect the return of the investee, basically you control this. Okay, then we're going to move to more deeper topics where we will discuss about what's the difference between joint operation, when you know this is the joint operation, what is the benefit, and what is the plus minus of the joint operation, and what's the plus minus with the joint venture. And then we're going to talk about the terms of the contractual agreement, and then we're going to talk about the silo, the ring fence of the one unit of the investee where you have the control, and then we're going to talk about the where the other facts and circumstances could really reverse whatever that you already agreed. Okay, so in this training we're going to learn a lot of topics, and then we're going to give you a lot of example where you can really know how to differentiate between the joint operation and joint venture. The couple of topics that we're going to cover during the training is the classification, what it's meant with the joint arrangement and contractual arrangement. This is like a twins. You have a joint arrangement, you should have a contractual agreement at the same time. And then we learn about the relevant activities. We have a joint control. We learn about what it's meant with the collective control. Probably you'll be a bit surprised that we have here joint control. We also have at the same time collective control. So what's the difference? And then we learn about the implicit joint control, and then about assessing the joint control, and then the potential voting rights that you have in the held by one of the joint venture in the joint venture or joint arrangement, and then you have an uneven split of interest. We also learn about the arbitration. We learn about the rights of veto, and the difference with the what we call is like a protective rights. Here we really have to understand what it's meant with the substantive rights and protective rights. And then we learn also about the operating restriction and other parties to the joint arrangement that do not share the joint control. So in the joint arrangement, you have a party that share the joint control, but at the same time you can have a party that do not share the joint control. And then we learn about the type of the joint arrangement. Here you have the joint arrangement that not in the spirit vehicle, and also joint arrangement that we have the spirit vehicle to cover the activities of the business activities of the joint arrangement. And then we also learn about the legal form of the spirit vehicle. And then the other things we need to learn about the terms of the contractual agreement, what is the impact and how to see that from the joint arrangement perspective. And then we have other facts and circumstances that also we have to really understand how's the impact to the joint arrangement. And then we also have the agreement that could cover more than one activities in one joint arrangement. And the other things is we're going to learn about the, of course, the accounting side a bit. Hopefully you are not really quite, you know, when you heard accounting, okay, we need to learn about the debit credit. No. In this training, we're going to we definitely not to discuss the debit and credit, but we will see a lot of things about the acquisition of the interest in the joint operation, how to see that joint ventures. This is the investor to parties to the joint arrangement, and then we learn about the equity accounting. Definitely, I'm going to touch a bit about the equity accounting. And then the net liability position of the joint venture, and then also parties that, and the other things that we're going to learn about the transaction with the joint operation and transaction with the joint venture. The transaction with the joint operation, we're going to cover the downstream transaction, upstream transaction, and then we also learn about how to account for the changes in the level of ownership while we, at the same time, we retain the joint control. And then in terms of the transaction with the joint arrangement, joint venture, we're going to learn about the formation of the joint venture, and then what we're going to book in our accounting when we have to contribute the asset, and then what happens when we have to lose the joint control during the period. So this is all the topic that we're going to cover within 2 days. Hopefully you're going to really able to come to our training class, and then we can sit down and then we can discuss and go through all these kinds of topic that cover the joint arrangement. See you, and thanks for your time. Bye bye.